Big inflation news this morning. Core inflation is down to 3.6% from 3.8%, and headline is coming in at 3.4%, which is in line with expectations. But that doesn't paint the whole picture. In this video, what I'm going to cover is both where inflation is going right now and its impact on the stock market, both in the short term and the long term, and how it will impact different asset classes like gold and crypto, because there are some very unique developments for that. So you want to go ahead and stick around for all of that information. Let's dive right into the inflation picture and what this all means by taking a look at the macro variables. Now, starting off with money supply growth, I'm estimating here that it's up to 0.6%. Last update was negative 0.3%. And money supply is important for inflation because it refers to the underlying growth that fuels inflation. So 0.6% on a year over year basis. Now, inflation just got updated today. 3.6% down from 3.8% on the core and 3.4%, which is slightly down on headline. When we take a look at this, although this inflationary number updated is still higher than desired, negative money supply growth, or what I'm estimating slightly positive money supply growth, is good in the short term for keeping inflationary pressure down. Although in the long term, that is absolutely not the case. I'm going to talk about that why in just a moment. Before I dive in, make sure to subscribe to the channel so you don't miss any new daily videos or macro updates. Continued unemployment claims, which measure rising unemployment levels, is up 32% from the economic cycle floor in June of 2022. This number is very high, and at these levels, a recession has occurred within 1 year due to a weak economy that is prone to shocks. And as you know, there are a lot of potential shocks out there, from even a simple one like a solar storm that could knock out power in extended economic regions, right? That would be enough to tip the economy that's already at these levels into a recession, for example. Now, currently, we are in year 2 of the market discount cycle. Every 3 to 4 years, the stock market performs poorly due to an alignment of monetary and fiscal policy with the political cycle to address economic issues. Even though a recession is possible, the discount cycle dictates that it's unlikely that restrictive monetary and fiscal policy will be allowed, which would negatively impact the stock market. Now, before I dive into how this will affect the stock market as a whole, especially this new inflation data, let's take a moment to step back and look at the big picture. The stock market can be categorized as being in a good year this year in 2024 because we are in year 2 of the market discount cycle. Now, it's important to understand the market discount cycle because if you were to follow the strategy on the previous table, which involves categorizing and investing around the predicted direction of the stock market, you would be, in this example, $1 million better off in this 15-year growth example of $100,000. Now, the reason why I'm saying that in the short term, inflation is decent, but in the long term, there's a lot of bad headwinds is because we need to take a look at major cycles. With major cycles, these are major world-changing domestic and international conflicts that follow a cycle that begins approximately every 84 and 248 years. Now, the theory around that is that astrological alignments cause predictable patterns of human behavior in the same way that tides are impacted by the moon. So right now we are at year 83 and 248 on the major cycle, which means we are about to enter into a major conflict period. Doesn't that sound right? Now, it's important to know that major cycles occur and what times they occur because they can bring about wildcard events that can impact the stock market that haven't been seen in most people's lifetime. Now, further adding an interesting tangent here to the inflationary narrative, solar cycles. So, interesting thing here, recessions tend to occur just after the peak of the solar cycle, with a median time of a little over 4 years after the beginning of or bottom of a new solar cycle. And as of this recording in May of 2024, we are right at the average amount of time for a recession to begin. That does not mean that one will start now. It just means we're right around the average median time. Now, let's take a look at the market valuation. Now, currently the stock market is overvalued, which means that it's poised for a bigger than normal drop during the market discount cycle. Right now, as you can see, we're at 27.5 and the average is 21.5. That's kind of where things go. And if things are really bad, it could undershoot that as well, as you see here after the 2000 and 2008 crash. Now, monetary policy is currently favorable to the stock market as interest rates should remain about the same or decrease should any shocks occur. And there's a positive narrative building around that if core inflation continues to go down. I'll talk about that more in the prediction section in just a moment. And fiscal policy is also favorable as we continue to have strong government spending, and government spending would increase should any kind of shocks impact the system. Now, before I give my prediction on what this means for not only inflation, but also the stock market, those growth names, and different asset classes like gold, silver, crypto, make sure to go ahead, click the button down below if you want to get stock rankings to find the very best opportunities, macro analysis, and also asset class analysis as well. So link down below for that. So here's the deal. Here's what this means for inflation, stocks, asset classes, etc. So inflation in the short term should continue to be roughly around 3, if not going down a little bit, up until the end of the year, given no shocks occur. Now, those shocks that will invariably happen, whether it's because of that timing of the market discount cycle, geopolitical major cycles all crescendoing, that 84 and 248 year, and also the solar cycle having that strong connection with having recessions right around the apex time, there's a high likelihood for some kind of economic event that would bring tremendous amounts of stimulation in a form of a shock that would cause inflationary pressure to be building. In the short term, that means that the macro environment is favorable for stocks, especially those hot growth names, Bitcoin, gold as well, kind of sniffing out what's coming in the next couple of years. But in the long term, there's definitely going to be that potential for macroeconomic disruptions and major cycle wildcard disruptions coming down the pipeline as well, which would bring significantly higher money supply growth and in return significantly higher inflation. So in the short term, we are favorable for the stock market, but in the long term, you're going to want to stick around and see more videos because it's going to be a pick it and choose it opportunity. There's going to be a lot of losers and you can play those, and a lot of winners as well. So stick around for all of those additional videos coming down the pipeline. That's all for this video. Make sure to subscribe to this channel so you don't miss daily videos and macro analysis updates. And I'll see you guys on the next video.